You're growing fast, but your bank balance still gives you anxiety. You've got dashboards, accountants, investors, and yet you don't trust your numbers. And without clear reporting, you risk making hiring calls, pricing changes, and fundraising decisions in the dark. This video shows you how to run a simple 1-hour ritual using just 3 reports that gives you total financial clarity, so that you stop second guessing yourself, spot issues early, and finally run your business with confidence that you've been missing. Hi, my name is Kishore Dasaka, and over the last 20 years, I've helped more than 250 founders make better financial decisions. So if your revenue is growing, your monthly reports might seem like another task that you need to delegate. But what if I tell you that skipping them is actually what's keeping you stuck? You see, when numbers feel off and decisions still feel foggy, something is clearly missing. Hiring, pricing, and fundraising all rely on accurate insight. But most founders don't know which numbers to trust. And without a simple cadence, problems compound silently until they are becoming urgent. And that's why smart founders don't wait for cash to get tight. They build a reporting ritual that flags issues before they become problems. Here are 3 reports that you, the founder, must review every month. The first report is the profit to cash bridge. You see profit on a report, but your bank balance tells a different story. So where did the money go? Early stage founders often misjudge their burn rate because they confuse profitability with cash availability. Deferred revenue, invoicing delays, and one-time costs. All of these distort your real cash position. Without a bridge between your P&L and your cash flow, you're making decisions based on false signals. This leads to overhiring, undersaving, and confusion during board or investor updates. A P&L is an accounting report. It often has accounting adjustments like accruals, deferred payments, capitalization, and depreciation. It usually never gives the correct picture. So therefore, you might see a $40,000 profit on your P&L, but your cash balance has actually gone down by $25,000. Why? This is exactly why you need a profit to cash bridge. It is essentially a reconciliation between the profit that you see in your P&L versus the movement in your cash balance. The profit to cash bridge shows exactly where your profit went and why it is not sitting in your bank account. The second report is what I call the gross margin by segment. It is tempting to chase growth wherever it appears. But what if your fastest growing segments are quietly draining your margins? Gross margins usually look fine in aggregate until you break it down. When you break it down by product, by region, by customer type, and can carry all different cost burdens, founders often discover that their best-selling plans are their least profitable. Without segment-wise analysis, you're scaling what is silently killing you. And after segmenting, you realize that SME customers have 40% higher gross margin and a lower churn. So you refocus your GTM efforts there. And that is why you need to review your gross margins by segment. When you break down gross margins by product, region, or customer type, you will spot silent killers hiding in fast-growing segments. You will suddenly realize that a sweet spot is making you great profits, and there is a small death spiral where you're slowly bleeding cash. The third report is the 13-week cash flow forecast. You might know your runway in months, but do you really know your cash flow in weeks? Most founders track cash flow monthly, not weekly. But monthly burn smooths over the real volatility in your cash flow. Your balance might still look fine on paper, while a single delayed payment or a surprise expense can wreck your plans. A 13-week forecasting forces you to get specific, line by line and week by week. And once you see it, you can act early. Here's an example. Your forecast shows a tight week coming in week number 7. You speed up 2 invoices, push a discretionary spend, and clear the bump before it hits. And that is why a rolling 13-week cash flow is very important. A rolling 13-week cash flow forecast lets you see week by week when your cash will tighten so that you can do a course correction on time. Once the right reports are in the right place, clarity becomes addictive. So how does that shift your way to operate as a founder? You start anticipating issues instead of reacting late. Pricing decisions become sharper because you see when value leaks. You lead hiring with confidence. You know margins can support it. Strategic calls stop becoming bottleneck at your desk because data speaks. And once you start reviewing these reports, hiring gets sharper, pricing gets clearer, and you stop being the bottleneck in every strategic call. If you found this video helpful, share it with another founder who may need it.